Welcome to the second video in our series, Investing. Where? How? The problem is most people haven't a clue about where to start. You need a good plan and great advice. Otherwise, you may find yourself lost amongst the enormity of it all. We're going to uncover how to guard your precious assets from money thieves that threaten your assets and reduce your buying power, and how to retire 10 years early without relying on your super or a pension. The first step to long-term wealth creation and prosperity-filled retirement is rock-solid planning and risk avoidance. In other words, what we are protecting you from is what I call money thieves. Money thieves number 1, credit card fees, which eat up your spending power like a drunken sailor on leave. Want to know the secret to long-term wealth? Reduce your bad debts, increase your good debts. It really can be just as simple as that. Money thieves number 2, inflation. From the year 1937 until today, the average rate of inflation in Australia has been about 6%. Let's round that down to about 4% to be conservative. That means with each passing year, the money you possess right now will purchase 4% less next year. With real estate, it's the exact opposite. As inflation goes up, so do real estate prices. Investing your money in real estate instead of bank savings or the share market is one of the easiest ways to combat inflation head-on and actually profit from it. Money thieves number 3, the share market. The share market has more hidden fees than you think. For example, every time you make a new trade, you're charged a fee. If you use a broker, you'll be forced to pay broker fees. You'll also be charged a capital gains tax at the end of the year. Unlike real estate, the capital gains tax from shares is nearly impossible to reduce. Now that you understand some common money thieves and how to avoid them, we can begin our journey. Getting started is always the hardest part for most people. The problem is, building a property portfolio seems hard, maybe even frightening to some. Well, here's the good news. Here's what you do instead. Action number 1, find a trustworthy company who can introduce you to property developers. Action number 2, you then buy the property from the developer who creates market trends. Action number 3, rent the property and keep for retirement income. If you have enough equity in your current home, that equity can act as your deposit on your investment property. And remember, that's good debt. There are 2 types of investors. Type 1 likes to do everything themselves. Type 2 real estate investors let someone else deal with the building and maintaining of each property and complete all of the boring and time-consuming research. Which type of investor would you rather be? So why sabotage your own retirement by trying to do all the hard work yourself? Let someone else do the hard work. Here are a handful of things you should have someone else help you with. Evaluating your needs and developing your strategy. Validating the claim of sellers and other real estate agents. Arranging inspections. Making sure you have proper insurance. Managing, submitting and confirming all documents. Setting rent value to avoid vacancy and turnover. Selecting qualified tenants from day 1. Dealing with calls 24 hours a day from needy tenants. Can you imagine how long that would take to do yourself? It would be a full-time job. In the next video, we're going to uncover one of the biggest and most common mistakes investors make, and that's in the area of financing. This is the one area you must get right. After all, you're financing a $400,000 plus house. Little changes can stack up to tens of thousands of dollars in extra profit.